Hey, welcome back to Caffeinated Money, your go-to source for financial education and stock market insights. I'm your host, Mike, here to help you brew up some financial success. Hot beverage. In today's video, we're going to dive into top 10 common investor mistakes and how to avoid them. Whether you're a seasoned investor or just starting out, we've got something for everyone. So, grab your favorite cup of joe and let's get started. But before we do, if you're new here, don't forget to hit that subscribe button and turn on notifications so you never miss out on our latest tips and tricks to secure your future. Let's get into it. New investors often make a variety of common mistakes as they navigate the complex world of investing. These mistakes can be costly and hinder their long-term financial goals. Here are the top 10 common mistakes new investors make, along with tips on how to avoid them. Lack of research and education. Mistake: new investors often start investing without a solid understanding of the financial markets, investment options, and strategies. Tips: start with the basics, read books, articles, and educational materials about investing. Familiarize yourself with terms like stocks, bonds, mutual funds, and ETFs. Take online courses or attend seminars on investing and financial literacy. Consider joining investment forums or communities to learn from experienced investors and ask questions. Ignoring diversification. Mistake: new investors sometimes concentrate their investments in a single stock or asset class, exposing themselves to higher risk. Tips: create a diversified portfolio. Spread your investments across various asset classes like stocks, bonds, real estate, and possibly alternative investments. Within each asset class, diversify further by investing in different sectors or industries. Regularly rebalance your portfolio to maintain your desired asset allocation. Trying to time the market. Mistake: new investors may attempt to predict short-term market movements, leading to frequent buying and selling. Tips: adopt a long-term perspective, focus on your investment goals, and avoid reacting to daily market fluctuations. Practice dollar-cost averaging. Invest a fixed amount of money at regular intervals, regardless of market conditions. This strategy can help reduce the impact of market timing. Consider using automatic investment plans to avoid impulsive decisions. Overlooking costs and fees. Mistake: new investors may not pay attention to the fees and expenses associated with their investments, which can erode returns over time. Tips: understand the different types of fees, learn about management fees, trading commissions, expense ratios, and any other costs associated with your investments. Choose low-cost options. Look for index funds or exchange-traded funds, ETFs, with low expense ratios. These funds typically have lower fees compared to actively managed funds. Be mindful of taxes. Consider tax-efficient investing strategies to minimize the impact of taxes on your returns. Letting emotions drive decisions. Mistake: new investors often make impulsive decisions based on emotions like fear or greed, leading to poor investment choices. Tips: develop a written investment plan, outline your goals, risk tolerance, and strategies in a plan. Refer to it during times of uncertainty to stay on track. Avoid checking your portfolio daily. Frequent monitoring can lead to emotional reactions. Review your investments periodically instead. Focus on the fundamentals. Base your decisions on research, analysis, and your investment plan rather than short-term market sentiment. Set clear goals. Mistake: some new investors start without a clear understanding of what they want to achieve through investing. Tips: define specific, measurable, and time-bound goals. Determine if you're investing for retirement, a down payment on a house, or another objective. Calculate the required investment amount, estimate how much you need to invest regularly to reach your goals. Build an emergency fund. Mistake: investing without an emergency fund can leave you vulnerable to unexpected financial emergencies. Tips: set aside 3 to 6 months' worth of living expenses in a separate, easily accessible savings account before you begin investing. The emergency fund acts as a financial safety net, allowing you to handle unexpected expenses without having to sell investments at a loss. Start small and gradually increase. Mistake: some new investors commit a large portion of their savings to investments without prior experience. Tips: begin with an amount you can afford to invest comfortably without affecting your daily life or causing financial stress. As you gain experience and confidence, gradually increase your investment contributions. Regularly review and rebalance. Mistake: neglecting to monitor your portfolio can result in an asset allocation that no longer aligns with your goals or risk tolerance. Tips: review your portfolio annually or when significant life changes occur, such as marriage, having children, or nearing retirement. Rebalance your portfolio by selling overperforming assets and buying underperforming ones to maintain your target allocation. Seek professional guidance. Mistake: some new investors may not seek advice from financial professionals or advisors. Tips: consider consulting a certified financial planner or advisor who can help you create a personalized investment strategy based on your goals and risk tolerance. Ensure the advisor acts in a fiduciary capacity, meaning they prioritize your best interests over their own. Remember that investing is a learning process, and it's okay to make mistakes along the way. However, by avoiding these common pitfalls and following these tips, new investors can increase their chances of building a successful, long-term investment portfolio. Well, money makers. That's it for today's deep dive into the world of finance. I hope you found our discussion on how to avoid these investing mistakes insightful and valuable. Remember, the key to financial success is knowledge, and that's what we're all about here at Caffeinated Money. If you enjoyed this video and found it helpful, don't forget to hit that like button and share it with your friends who might also be interested in growing their wealth. Your support helps us create more content like this. And if you haven't already, click that subscribe button and the bell icon so you won't miss out on our future videos. We've got a lot more financial insights and stock market tips coming your way. Before we wrap up, I'd love to hear from you. What was your biggest takeaway from today's video? Do you have any questions or topics you'd like us to cover in future videos? Let us know in the comments below. Remember, the journey to financial success is a marathon, not a sprint. So, keep learning, stay invested, and let's make that money work for us. Until next time, this is Mike, signing off from Caffeinated Money. Stay savvy, money makers.